Hello and welcome. My name's Steve Lambeth. I'm an investment analyst and portfolio manager at Climb. And with me today, I have Oscar King, who's a senior investment analyst at Climb. We both work together in the Aussie equities team. And this week, as a change up, where Paul and John are having a break, we're going to do an episode of The View here, spend about 10 minutes having some interaction. It's an interesting juncture for equities, of course, and Oscar is our specialist in all things the consumer and tech sectors. So we're going to have a bit of Q&A and a bit of a chat on some insights there. To flavour the conversation at the outset, as you know, we've had a fairly buoyant period since the depths of Liberation Day, including our market. In the month of July specifically, markets continued to grind higher. Our market was up 2%, and of interest for our market, where we had some pressure on financials, a bit of profit taking in the big end of town, for example, CBA, we saw rotation and a broadening out of the rally to other sectors. What stood out, I thought, was that it wasn't a one-way street of resources getting a bid. In fact, it was healthcare that did best, and fortunately, our portfolios are positioned well for that kind of dynamic. But there were other sectors as well that got involved and had some growth. It finds us now at the doorstep of reporting season. So here we are with what will be a huge injection of information. The majority of companies at this time of year are reporting their full year results, which means we get a full set of accounts. We get a very heavy delivery of news, and it's a very important time to be engaged. What's interesting as well as context to the market environment in Australia, different to the US, which is having its reporting season and demonstrating continued growth. The ASX is, by contrast, a market without a great deal of growth. In fact, the last 3 fiscal years, the ASX in total has seen earnings move sideways to down. So there is a forecast improvement, which is understandable, but we had these forecasts for improvement and saw earnings revisions turn negative, which had earnings land flat. So that is of acute interest. I'll come back later and share some topics that we're thinking about as we head into reporting season. But Oscar, perhaps for what has been you taking a lot of interest in the Mag 7, in tech, and also consumer, maybe we could just have a chat consumer-wise in Australia.
Yep.
We've not been there. We've observed challenges in all things the housing sector, the household consumer sector. Could you just run through sort of your thinking about maybe what results to be thinking about and what the setup looks like for consumer into 2026?
Sure. Thanks, Steve, and good to be here on the View again. Yeah, it's an interesting setup, I think, heading into the 25 results season in August. We've had this confluence of, I guess, elevated interest rates, elevated inflation, which theoretically, against a backdrop for consumer, it has been, I guess, pressure on the household budgets with mortgages, given Australia's majority is variable rates versus the US, where we see large portion of those mortgages are fixed and long term. So what we're sort of thinking, I guess, heading into the results season is that we've seen, I guess, a confluence over the last year, whether it's, the banks, whether it's the miners, whether it's the retailers. We've sort of seen this liquidity premium being placed on the market. So the big dogs, call it your Wesfarmers, your JB Hi-Fis, these names which, whilst earnings delivery haven't been poor, let's say JB Hi-Fi, a large portion of the valuation creation over the last year has actually been driven by PE expansion. So what we're thinking heading into this results is there is an elevated level of caution, especially around these names that are rated on premium multiples, especially above what the historical norms are. Now, when we look at the market backdrop for the ASX in general, we're at elevated levels of PEs. It's around 20 times. Whether it's right or wrong, we'll soon find out. Earnings are what ultimately drive share prices in the long term. But what we're sort of thinking is that the margin for error is very, very low when we go into this reporting season. You need to have this hurdle rate much higher. Going back to your comment around the Mag 7 and what we were thinking around these sort of names and the read-throughs, look, Microsoft and Meta, formerly Facebook, they delivered blockbuster results with AI coming through in spades. But then on the flip side, you have Amazon, once again, high hurdle rate, premium valuation, and then that was knocked around on the day as well. So we would expect the volatility as we go into reporting season and probably to continue in the years out to be more elevated. Maybe there's an influence of AI and trading in the markets as well from quantum computing, and what we're actually seeing on the day, it's either trade up or trade down, but it's probably over exaggerated to the upside and the downside. So normally you will see maybe 1 or 2 days afterwards when I guess the water sort of flows under the bridge in terms of people processing the information and what it actually means for the future of these earnings. But I guess more specifically for the consumer name, as you said, we haven't really been there. We've had our bets placed, more so on the US consumer through names like Aristocrat, who viewers may be familiar with, are the leader in global gaming or global gaming supplies, being poker machines. But when we're thinking about the way we're positioned for this reporting season and into FY26, the backdrop for the consumer is favourable. We've got key things like interest rates, they are coming down, not going up. So the trend is our friend. That is positive, and that should flow through into earnings. I guess the biggest question that everyone has on their mind is tariffs. There was the big tariff scare, and we saw the markets down 25%, being the US, and then obviously the Australian market sort of followed suit as well in that early April, May, and we're back at all-time highs. So it just seems like we're maybe potentially in a bit of an air pocket, and especially some companies are going to be more exposed to that than others. One name that comes to I guess to mind would be Breville. It's one that we're very interested in. It follows a growth category being coffee or at-home coffee, but 40% of its earnings are in the US, and whether they can actually foresee or whether they can actually manage the impact of tariff is going to be the question for FY26 earnings, given they were previously elevated and forecasting, call it 6% EBIT growth. So when we look at the 26 forecasts for the consumer name, FactSet's roughly estimating around 9% growth for the consumer. When we actually look at the consumer staples, so think of names like Coles, Woolworths, Metcash, Treasury Wine, the forecast for the market's around 8%. So the relative value of what we're actually seeing in the market is that there is a lot of demand for consumer or consumer discretionary. People or investors are willing to pay up for it. However, you have these valuation dispersions between where Woolworths and where Coles are trading at relative to their history, but also have a benefit from what's going to happen from flowing through to the consumer as well, from an inflation and an interest rate perspective as well. Plus, you have all these initiatives coming through from Coles with their private label penetration of products, and also the optimization of their supply chain as well.
Right. That's great. Great summary. If I am reading what you're saying correctly, the energy expenditure going on at the moment is really trying to arrive at what consumer discretionary name here may be a suitable name for our portfolios, where we've taken a step back from having exposure to the US consumer. And I think worthwhile, without letting macro have a huge influence on the thinking here, we did have a second name in US consumer discretionary that we removed. We nonetheless did take account some of the settings that John Abernethy and Paul were describing to us being in the US. The rate backdrop is one where the short end's less relevant than the long end. The long end remains elevated. We've been doing a lot of work to think about, at some point when that changes, if and when it does, a name like Reece would be worthy of consideration. Perhaps even a name like James Hardie, notwithstanding there's been some challenges digesting a large acquisition, there is reason to take interest in what could be a change for the better from a cyclical backdrop. But in the meantime, it's really quite evident that at some point here, with rates coming down, it will breathe some sort of life into all things housing and consumer. One thing we're sensitive to, of course, Oscar, is when we saw New Zealand go through a journey some time ago, it still hasn't printed green shoots. Do you have any rules of thumb on when it is rate cuts happen and then we start to see the consumer respond?
Yeah, so the rule of thumb is New Zealand's a little bit more skewed to, it's a lagged indicator because they have a more similar to the US, a large portion of their mortgages are fixed versus variable. So it's around a 6 to 9 month flow through impact in Australia between when the RBA makes a decision on what the interest rates is, whether it's up or down. Obviously, if it's an interest rate rise, it's going to go through straight away from the banks. They want to collect that interest income as soon as they can. But we just see that, I guess, the trend from here is similar to inflation. Everyone, as you said, we don't want to get too caught up on macro, but everyone was so fearful that inflation was going to keep going higher and higher. But the trend has started to go down and it's continued to go down, and now it's sort of benign at where it sort of sits at today. So the real question is, well, are we placing our bets on interest rates going up or down? And for the Australian outlook and also New Zealand, which has been leading, interest rates are going down, which should feed through into a more favourable outlook for the consumer heading into FY26 and FY27. I guess the function of that is, as I mentioned before, in regards to how analysts are thinking about forecasts and so forth. What we get at these upcoming results is, how was I thinking about it, and was I right or was I wrong, and was I right for the right reason or was I wrong for the wrong reason? And then you sort of then overlay, perhaps there's an EPS or there's an EPS upgrade or downgrade, and that's sort of what we're sort of looking for. Are those companies delivering? Are they meeting expectations? And how are they doing it? You mentioned James Hardie before. Also in the tech space, we've had Xero make a big acquisition. So it seems like there are appetites for growth over and above what we have in the Australian market. We know that it's quite small, but that doesn't mean you can't do well. We've seen that with retailers. And there is a very, I guess, clear footpath to, I guess, that success, and typically that has been that store rollout story. So there's lots of names that we're interested in, but at this point in time, we've sort of just been doing the work on where we think our bets are placed, and where we think that, I guess, on flipping the coin, so to speak, where we've got more of a probability of getting it right and wrong. And at this point in time, it seems more favourable to be, I guess, a bit more defensively positioned, being staples. The relative valuation stacks up as well. So that's sort of how we're thinking about it.
Yeah, that's great. We'll jump across to tech in a moment. I think a point Oscar's making there for everyone to be aware of course, when it comes to retail, there's a saying, retail is detail. Have a look at the difference between the performance of Eagers Automotive and PWR, or have a look at ASG. I mean, for what are businesses doing the same thing? Peter Warren and Autosport have had a great time, followed by a horrific time dealing with the goings on in COVID. Meanwhile, market leadership company called Eagers Automotive has defied the mean reversion out of right-sizing costs, investing in technology, and ultimately gaining market share to overcome the cyclical overlay that has happened. And I think the same such observations do apply more broadly to retail. Readers would know and investors would know we've had a position on in Ampol up against VEA, Viva Energy, and in large that's because we've observed a difference in the execution capability of operating retail networks. That flows then into, when it comes to the work Oscar will be doing over reporting season, it will be beyond the macro and what rate cuts mean for consumer spending. It will be very dialed into the idiosyncrasies of the business, the assets that they have, the strategy they have. The industry backdrop matters, but it doesn't dominate. And so we will come through the other side and hopefully have an update. No one reporting season is ever ultimately defining. It is just another such injection of results that helps shape the thinking and the conversation that's already been happening in the background. So we'll keep you posted on whether we land anything in this sort of consumer
Yep.
and household space. There are broader names than just discretionary retail that will have help as interest rates come down. So housing comes to mind, possibly property development. So we'll report back on that. Just in the interest of time, we might just have a quick chat on tech.
Sure.
So if you could just share with the audience how it is we've positioned ourselves from an AI story,
Yep.
and
Yep.
what you're sort of observing with the US results coming through. Is the story still intact?
Yep.
And what's our picks and shovels play?
Yeah, sure. So I guess what Steve's talking about is when we think about how the evolution of technology and how to play the AI story is you've got three broad buckets. You've got the underlying what is fueling the AI, and that's the silicon, that's the semiconductors, GPUs, CPUs. We don't have much of that exposure as listeners or readers may be aware in Australia. But what we do have in Australia is we've got, I guess, the hotels for where the infrastructure is stored, being data centers, and we also have applications that sit on top of those things that are inside the hotels and basically run on it. So for us, the way that we think about it is where are we going to get the best value creation, I guess, upside versus downside in this market? And the name that we have placed our bets on has been Goodman Group. It's it's a very well run business. It's got a long track record of history, and essentially part of the reason why we like it is that they're leaning on their existing assets that are cash flow positive. They are generating profit to be able to assist them to fuel this next leg of growth and execute. And interestingly, part of that story sort of got fueled from when they did that capital raise. They raised about $4 billion, I think it was. And that was the point in time where we said, look, this is the time that we want to lean in a bit more, increase the portfolio weight size. We are starved for opportunities in terms of tech in Australia, especially when it comes to valuation. If you want growth in Oz, you have to pay up for it. We're even seeing that with CBA, even though despite there's not much EPS growth there, but that's sort of beside the waypoint. But I guess when we're thinking about the outlook, it was sort of reinforced as well, and I'm not too sure if people are aware, but Goodman Group actually went out and they hired one of Microsoft's ex head of DCs, and that was a point in time where I said to Steve that and the team that these guys are clearly on the ball and they know what they want, and they're going headhunting, similar to what we're seeing with Meta, going after all these key AI players, because at the end of the day, it's a talent war. If you've got the guys that understand the build out, how to do it and how to roll it out, and you're willing to put them on a big pay packet, at the end of the day, it's very small. It's a small drop in the ocean relative to the earnings opportunity in terms of what the TAM is. And we've seen that, reinforced by the amount of money that the US government has recently, I guess, basically put their hand in their pocket for around what they're willing to spend over the next couple of years with the new AI agenda, which President Trump signed off on last week, I think it was. So for us, that's the way that we're playing it so far in the infrastructure. We are very interested in those other names in Australia that do sit on top of the application layer. But I think once again, as comes with every sort of innovation cycle, there are winners that sit outside of that. Think healthcare. Healthcare will be one of the biggest beneficiaries of AI. I know that Pro Medicus is a name that investors will probably, and listeners will probably be aware of. However, once again, applying Climb's investment approach, we are valuation eccentric, and we do have a tendency to question the sustainability of that. So I think that when we're thinking about the future of, how can other companies benefit from it, it's not just tech companies. Of course, there's other players that can benefit from it as well. Even think advertising, even think journalism, all these sort of other names that can benefit. And ultimately, what we're looking for is, can we see an acceleration in the growth rate? Can we see an acceleration in the margin profile? And that's essentially where a lot of these players that we're trying to sort for are going after. Another name would be WiseTech, albeit it's got a few spots in its past. But that being said, founder-led has proved itself time and time again over the last, call it 5-10 years. And that's a name that we're still trying to work our way through in terms of getting comfort with what their service offering is and what the market's signed up for. So I think that largely sort of covers the Oz names. In terms of the US, I'll just briefly touch on that. I mentioned at the very beginning of the call that Microsoft and Meta had an absolute bombburster of a result. We are seeing an explosion in their acceleration of their growth rates. And I think I was reading a post the other day just talking around, if you look at the growth rate of what they were printing pre the AI story, they've obviously just accelerated massively. The question now is, of course, well, because you're having to build out all this capacity to fuel it, what does it do to margins? I was actually listening to a call with Microsoft this morning, and they were saying that there is going to be a gross margin impact because as you depreciate these assets of CapEx over the next couple of years, being like servers and CPUs and these sorts of things, it will actually impact margins. So there's going to be an interesting story around how it gets managed. But at the end of the day, part of the reason why these companies trade on a premium versus the market is because they are the best. They've got pricing power and they've got the best products. So that's ultimately what it comes down to at the end of the day.
What a great summary. Yeah, we'll wrap up in a moment. I think a summary takeaway there from what Oscar described in tech is, yeah, first and foremost, the obvious second derivative of all the spending going on in AI is accessing infrastructure plays, of which we've chosen Goodman Group. Infratel's a peer. Another peer would be NXT. We've done work on those names, but across our criteria of value creation attributes and aligning those attributes with what's reflected in share prices, we think Goodman Group is the best way to get involved. When it comes to applications, the summary is we're looking, it's early days. As you know, the monetization of AI has only just started. I think I saw a stat overnight about the growth in ChatGPT users now being around about 700 million, of which only about 5 million are paying subs. So this is analogous to the early teens, 2010s, when we had the commencement of internet news and there was next to no one paying for that news. Eventually, of course, the usage becomes so entrenched, we do have a preparedness to pay. So that will come down the pipe at some point. In the meantime, applications and the thought of what will work, we're either thinking about one or two things. Is the application benefiting the user experience, or is the application of AI helping a more productive organization? So that could be thought of as freeing up labor, or it could be thought of as here's a person interacting with in the case of, say, one of the online classifieds, or in the case of a tech stock, here's a better way to serve a customer from a UX perspective. And then separate to that, in weaving through the game plan to achieve that monetization, is the company buying access to the capability, or are they investing organically to make that happen as well? So when it came to Xero and Melio, that's an example of, as much as it wasn't an outright AI purchase, it was a purchase all the same to better the UX, and they are promoting an opportunity to get synergy. So that's the sort of work we have to do to frame whether that represents value for shareholders. We're going to stop there. We're obviously at the doorstep of reporting season. I'll just leave you with this. We've had two stocks report to date, ResMed and Newmont, and they've both had very strong results with upgrades. So the portfolio hopefully has kicked off to a good start, and long may that continue. We have QBE this Friday. So looking forward to updating you on the other side of reporting season. Thanks very much for watching, and thanks, Oscar, for coming along.
Thank you. Cheers.